we go on to our next panel, Innovation in ETFs. And we are going to bring out our panelists here. Jesse Pound with CNBC is going to moderate the panel. Okay. Natasha with Greiner is the director of the Division of Investment Management at the US SEC and oversees all funds, all ETFs, and a whole lot of other things. Next to Natasha is Gerard O'Reilly. Gerard is co-chief executive officer and co-chief investment officer at Dimensional Funds. And we're delighted also to have Samara Cohen, chief investment officer for ETFs and index investments at BlackRock. So we have a fantastic panel, and Jesse, it's all to you.
All right, thank you, Rena. Hello, I am Jesse Pound. I'm a reporter with CNBC.com and CNBC Pro. Since Rena already gave our introductions, I think I'll just go ahead and get right to the questions. So ETFs, which are about 40 years old now in the US, have traditionally been associated with passive investing, big, cheap index funds that are sort of the building blocks for a lot of investor portfolios. But that's changed a lot in the last couple of years. Active ETFs are now growing faster than passive ETFs, partly due to an SEC rule change in 2019. Natasha, can you sort of give us a couple stats and put the growth of active funds in context?
Yeah, happy to. First, thank you so much for the invitation to speak today. I have to give my formal disclaimer. I feel more so because I've got a CNBC moderator. But the remarks today are made in my official capacity as I am director and do not necessarily reflect the views of the commission, the commissioners, or the members of the staff. So the ETF market, as of last month, there's about 3,400 US registered ETFs, and over 1,500 of those are actively managed. And the number of actively managed ETFs has grown about 33% just this past year. But I think putting it into context, I think it's good to know that actively managed ETFs are still only about 88% of the ETF assets. And there's about 9.5 trillion assets that are managed in more than 3,400 ETFs as of last month. I think you said it well, just for purposes of talking about passive and actively managed ETFs. You know, I think the rule, the 60/11 rule, which was adopted in 2019, really kind of changed the tone and tenor, and is an example of kind of how our exemptive process, which I'm sure we'll talk about a little bit today, informs our rulemaking, and that rule in itself really streamlined the process to go and launch ETFs. And I think it really created a level playing field. And honestly, the topic today, it really promoted innovation, which is what we're going to talk about today.
Great. We have Gerard with us. Dimensional is one of the largest has several of the largest active funds on the market. Gerard, can you tell us a little bit about how Dimensional approaches active management within ETFs and how that differs from maybe traditional stock picking?
Yeah. So I think that, the whole active passive, I prefer index versus non-index in terms of categorizing. Before Rule 6011, the majority of ETFs by far were index-based ETFs. And you have index ETFs that are more passive in nature. I think of passive as not trying to outguess market prices, accepting the information in market prices, and active as traditionally at least being around market timing or trying to pick undervalued, overvalued securities. And so you had a lot of index-based ETFs, but some of those indexes were what you might call passive, and some indexes were kind of designed around more active mentality. And I think what Rule 6011 did was allow to go to non-index. And from our perspective, you can have a lot of the benefits of an index-based implementation. You can have broad diversification, you can have low turnover, you can have low expense ratios. But indexing in itself is inherently inflexible in how it adapts to changing markets and how you can implement a particular asset allocation. So I think that this whole active versus passive and active ETFs may be confusing for some investors because they think the traditional stock picking or market timing strategies inside an ETF wrapper, and that's not necessarily the case. Our view is that since Rule 6011 has come along, the conversation around investment strategies in the ETF wrapper has become greatly enriched. Whereas before, I think there was more emphasis on fees, on spreads, on liquidity. Now the emphasis is on what's the investment proposition within this ETF wrapper. So I think Rule 6011, to Natasha's point, has encouraged a lot of innovation, a lot of non-index approaches to come to the marketplace. And I think that's been good for investors, lots of choice, additional choice around the wrapper, because the wrapper should not be the first thing that you look at. Investment proposition first, wrapper second.
Great. Samara, could you tell us a little bit about how BlackRock is thinking about active? And you've had some success with funds like BINC. How do you choose which strategies, active strategies, you want to put into an ETF?
Sure, and I'm going to make 3 quick points, but the first is just to really underscore what Gerard just said. If you all have one takeaway that I hope you take from today's panel, I hope we can eradicate the use of the word passive in talking about index portfolio management. For all the reasons Gerard said, there's truly nothing passive about an investor's decision to utilize an index vehicle or an ETF as part of their investment strategy. And frankly, at BlackRock, and I know this is true for Dimensional as well, there's nothing passive about how we manage our ETF and index books. So I far prefer the construct of index to active and the spectrum that represents. So that's point 1. Point 2, I thought the questions actually to the prior panel were fantastic. I actually want to root our discussion actually into what came up in talking about the post global financial crisis developments and response and what we've seen in U.S. markets since 2008. Wildly paraphrasing here, what happened in 2008 and the years to follow was a regulatory regime and tailwinds, as well as technology tailwinds, that really prioritized transparency, access, counterparty risk mitigation in markets. All of those things really drove more lit, transparent trading on exchange, right? So the developments that were talked about in the prior panel in equity markets directly relate to what has happened in exchange-traded funds and how exchange-traded funds allow investors to come to the equity markets and the structure provided by equity markets in accessing a broad range of strategies beyond single stocks. So that's point 2. And point 3 is really, to Natasha's point, which is, happy 5th birthday to 6C11, also known as the ETF rule, the importance of that clarity and consistency so that issuers, like BlackRock Dimensional, can be very thoughtful about the broader set of strategies that we put into ETFs. And now, just for a quick specific answer to your question, we think about 3 categories of active. They are alpha seeking, outcome, and exposures. And we think about all 3 with respect to what we want to put in an ETF. An alpha-seeking ETF to us, and this is a framework we find useful, is one that seeks to outperform a standard market benchmark. An outcome ETF is one that is not looking to outperform a benchmark, but is seeking to deliver a specific outcome, often by using embedded derivatives, for example, levered ETFs. And lately, we've seen significant growth in buffered ETFs that offer market participation to the upside with limited downside. And the third bit, exposure, is access to markets that are harder to index. So that's how we think about it.
Great. I want to go back real quick to your point about transparency in markets. One of the concerns that maybe old school fund managers had about working within an ETF is that, for the most part, the holdings are published daily. There are ways within the SEC rules to have semi-transparent ETFs, but those haven't really found a lot of footing. Do you have any insight there?
Sure. I think, and this has been a big win for investors. If you had asked me, and I think many of my peers in the industry 5 or so years ago, what we thought about this alpha-seeking category. You have some sort of specific proprietary methodology that's going to help you outperform the benchmark. We would have said those alpha-seeking portfolio managers would not want to put their strategy out there with the daily transparency of an ETF in the market. So the only way for those strategies to grow would actually be in some sort of non-transparent active form. And actually, we were wrong on that. And I think that's been a big win for investors. For the most part, portfolio managers who are deploying their alpha-seeking strategies in ETFs have actually been pretty comfortable with the daily transparency aspect of ETFs, and that's why we haven't seen as much growth in the non-transparent active. Another piece that I just think is interesting and just in the category of things we didn't expect, in some of the early experiments with non-transparent active, and I think this gets to one of the questions earlier about new applications of technology in markets. Some of those non-transparent structures were actually relatively easy to reverse engineer, kind of negating the rationale for masking holdings anyway.
Yeah, one item I'd add on that, and I agree, is that at least for dimensional, if you have a strategy that's broadly diversified, has reasonably low turnover, then you're not giving away that much information when you're transparent or non-transparent. And where you typically would see that give up in information is in your trading costs. When you go to execute trades, are you getting adversely selected, or are your trading costs deteriorating as you increase transparency? And what we've found for broadly diversified strategies is that that's just not the case, in particular when they have flexibility on the implementation. So what you trade on a given day is not necessarily reflective of the entire portfolio. And with that flexibility, there's been no deterioration in trading costs with respect to mutual funds, where you might lag the holdings by 30 days versus the ETFs under Rule 6c11, where they're available daily. So I agree with Samara that the whole transparency, not for all strategies presumably, but for many strategies, can be quite a good implementation.
Great. So as ETFs have grown, some of that growth has come at the expense of mutual funds. Sometimes that is in just money coming out of mutual funds or not going into them and going into ETFs instead. In some cases, fund companies are actually converting their mutual funds into ETFs. Natasha, can you sort of help us understand the growth of ETFs versus mutual funds?
So there has been definitely a growth in the ETF market compared to mutual funds. I think that we're going to talk a little bit about the conversion interest of investors or fund complexes to convert mutual funds to ETFs. And there is a lot of interest in that. And it's something from a policy perspective that we continue to monitor, whether it's even in my prior role in the examination division, but also in the division of IM, just kind of making sure that the general principles of mutual funds and ETFs kind of consist. The ETF conversion topic, I think the first conversion was in 2021, and things that we think about, and Gerard and Samara have talked about, like there are investors that really want that ETF wrapper, and so the concept of kind of conversion from mutual funds to ETFs is of a lot of interest. But we kind of, when these type of conversions raise questions for us, whether or not shareholder vote is required, whether existing mutual fund investors that don't have the ability to convert, what do you do with those type of investors when you're doing a conversion of such? Are they left behind? What are the costs associated, and are they fully disclosed? So a lot of kind of policy-related questions as it comes to that. But there is definitely a kind of a transition from mutual funds to ETFs, and just kind of a parallel the conversion, but also just the growth of the market itself. There's a lot of interest in ETFs for a lot of different reasons, which I know the rest of us will talk about. But I think there's benefits to the product and a lot of interest, especially initially when ETFs first were launched, not so much. Today, as I talked earlier, the market has really exploded and grown exponentially. So a lot of innovative thoughts. I think, just going back to what Samara said, the Rule 9c11 not only created efficiency for the commission staff, because we didn't need to approve all these exemptive applications, and it also helped the industry to be innovative and grow without having to come in. There wasn't this cost and time burden that was kind of embedded in the process. But it also enabled us is to kind of look at the industry kind of whole and focus on what I would say the more innovative aspects of the industry and these types of products. And so we're spending less time on what I call the plain vanilla ETFs and more on the complex types of ETFs like non-transparent. It's funny because you use the word semi-transparent, and I actually had to go back to my staff and be like, what is this semi-transparent? Clearly an industry term because we call it non-transparent. So I was happy to hear that she also said non-transparent. But really kind of focus our efforts also within the division on these type of novel and very complex products. We spend a lot of time engaging with applicants on these type of issues, whether you need exemptive relief or not, but also on the fund side for purposes of disclosure review.
Great. Gerard, Dimensional is one of several firms that's pushing to be able to add an ETF share class within an existing mutual fund. Can you tell us a little bit about why you see that as beneficial to your investors, and are there any technical hurdles you need to get over to have both coexist?
Yeah, so just commenting on some of the remarks that Natasha made as well. When we converted some of our mutual funds into ETFs, they were tax-managed funds, and what that meant is that 99.9% of the assets were on brokerage platforms because they were held generally in taxable accounts. And they were managed with an eye towards maximizing after-tax wealth. And so that kind of got over the hurdle that Natasha mentioned, which is around if you convert to a mutual fund to an ETF and there's a whole lot of assets on a 401k platform, suddenly those folks are going to be cashed out. We didn't have that issue with the funds that we converted. And so that's why one of the inputs into why that was a good outcome for the investors in those funds. We have other funds where the kind of the mix between tax-deferred and taxable assets is quite a bit different. And what we've heard, we work predominantly with financial professionals, and typically financial professionals these days are more holistic wealth planners. They try to minimize all implementation costs for the families that they serve. So they're typically fiduciaries for the families that they serve. And they care about taxes, they care about platform fees, whether that's commissions or other types of explicit platform fees. And they care about the technologies that can be used to implement different types of asset allocations on behalf of their clients so they can be more efficient and pass on those cost savings to their clients. And I think that's among the drivers of why many financial professionals like using ETFs and taxable accounts for their clients, because most ETFs trade without a commission on various different platforms. So for us, there's two big drivers. One, we have investors in our funds who have been there a very long time with lots of embedded capital gains. We would like to give the financial professionals the choice for those investors to be able to convert their mutual fund shares to ETF shares. So not a full conversion, but you could think of it in some respects as a partial. We think that's a good outcome for those investors. And two, investors often have strategies in their taxable account, strategies in their tax-deferred account. It's nice when they can have similar strategies in both with similar returns. That makes a kind of an easier implementation for investors. And we think that the exemptive relief for share class ETFs can help solve those issues. There's technical issues, are many. We're working with the SEC staff, and that continues. We have some great conversations there. But you need exemptive relief from the SEC in order to be able to accommodate that. Then, of course, you have to work with the various different custodians, the transfer agents, the platforms, and so on, to make all of that come to life. So I think it's a win for dimensional investors if it can happen, but I also think it's a win for the industry. Natasha mentioned flows from mutual funds to ETFs. Those flows don't have to incur trading. If you can enable ETF share classes and people can, if they're happy with their mutual fund today, just hold it in an ETF wrapper rather than the mutual fund wrapper, which I think ultimately is good for future ETF holders and existing mutual fund holders.
I can talk on this issue. ETF share class was, when I took on this role in March, was the number one topic that came to my attention. I felt like I could walk down the street and someone would be like, what are you doing about ETF share, multi-share class? So I will say we have over 20 applications right now. We're working with applicants directly, having a lot of great dialogue on the complex issues that I think were addressed in the 2019 release. So when 6C11 was adopted, the Commission opted not to kind of touch upon this issue and kind of left it to kind of be discussed at a later point, and really to kind of give us time to think through a lot of the policy considerations, the inherent conflicts that we talk about, the cost subsidization questions that we have. And so where there's a lot of great dialogue that we're having with the industry, and we continue to with that dialogue. It's not an easy answer. I think a lot of applicants come in thinking we can kind of solve this problem, provide the exempt relief, but we're really trying to see it holistically, kind of like the umbrella to really address some of the concerns that the Commission noted in the 2019 adopting release. So no answer or path forward yet, but a lot of great conversations happening behind the scenes. So.
Great. We are running short on time, but I want to squeeze in 2 quick questions about ETFs outside of traditional equities and bond funds. One of which, the big one this year, is crypto ETFs. Bitcoin funds launched in January and have been a big success. ETH funds launched later in the year. Samara, can you tell us a little bit about what BlackRock has learned with the crypto ETFs?
Sure. I think what we have all learned about crypto ETFs is that investors really value ETFs as a wrapper for market exposures. I think when I was first approached about Bitcoin ETFs 6 or 7 years ago, I thought, why would you take this crypto asset class that promises total access and transparency and put it in an ETF wrapper? Doesn't that kind of deprecate the promise of crypto market structure? And in fact, it turned out that investors really, as much as they increasingly, and what we've seen, and actually I'm going to make my comments specific to Bitcoin, because for a panel, maybe your later panel, you will talk about different crypto assets. But one of the things that really characterized investor demand over the last 5 years was increasing interest in Bitcoin, and Bitcoin as in its role as a portfolio diversifier. And what we heard from investors was actually, it was quite difficult to manage their holistic portfolio risk by living in 2 separate ecosystems, by having to buy crypto in the crypto ecosystem and having the rest of their investment assets in their traditional brokerage account. On top of which, they were often looking to access Bitcoin in proxy types of ways that weren't actually delivering the underlying crypto assets. So the importance of the ETF wrapper as a scalable, really bridge into people's portfolios was, I think, the most profound learning. That, and increasingly how investors do plan to use Bitcoin in their portfolios. And I'm sure we'll hear this in Q&A, but the one thing that we all get asked about all the time are now crypto, Bitcoin, as well as private markets. Both play a diversifying role in investor portfolios, and so both, therefore, are an area where investors are increasingly interested in ETFs and indexation. Do you like that bridge to Q&A, maybe?
Well, I was just going to note one thing, because it's an ETF innovation panel, and obviously crypto in ETF wrapper is innovative, but one thing I think the term kind of gets misused in this. There's a lot of, the media, public industry talks about ETFs, and I think the thing to mention is, like, when we're talking about spot Bitcoin ETPs, they're exchange traded products. They're actually not under the 40 Act. They're not a 40 Act product, and so they're not the same protections and some of the same considerations relating to custody that we're kind of grappling with. And so, again, as you're looking at the product, you need to understand what protections that you may or may not have when you're investing in that particular type of product.
Great. Yes, I have already apologized to Natasha on behalf of the entire media industry that we refuse to call them ETPs.
Yeah. I feel like you could probably apologize for a lot of things, but I'm happy to take that as a
One at a time. One at a time. Great. So I think we will move on to questions now.
Hi, thank you all for speaking today. I'm Michelle. I'm a current sophomore in the MSB and also a student assistant at the center. And I was just curious kind of about the relationship between regulation and innovation. You know, as the ETF market evolves, how do you think that new regulations and also market developments are going to kind of impact firms' abilities to innovate? And do you see these factors, whether that be competition, you know, technology, Bitcoin, or like investor sentiment, as barriers or as opportunities to create more sophisticated or more specialized offerings?
I can answer that from a regulatory perspective. So there's such a tension between innovation and the regulatory landscape. You know, I think we really want to promote innovation, but we have to remember the core principles of our federal securities laws when we're doing so, for all the reasons that you can imagine, you know, protecting investors, fair and orderly markets, you know, the core principle mission of the commission. And so from my perspective, that's the biggest concern. But we love the dialogue. I think the dialogue we have with the industry about potential innovative products, we want to try to encourage these types of products. I think it's better for investors to have access to more options to the extent that they're interested in investing. But we also need to, and I can get, I'll let my fellow panelists talk about it, but I'm sure from an industry perspective, it can be frustrating because we do really have to walk through methodically all the concerns or issues that we have based on kind of, again, what kind of the core principles of whether it's the 40 Act or 34 Act or 33 Act for that matter. And you know, there's a lot of dialogue within the building, but also outside the building, and those types of discussions are helpful. The other thing, just as a regulator, is trying to keep up pace. Like it is very hard to do our daily job, but also understand where the industry is heading. So without those conversations, we go blindly, but we're very proactive and we try to continue to have those conversations so that we understand what's coming around the corner, so that we're thinking about the potential risks, so that we can, you know, if we can promote the innovation, I think many of us would like to do so.
And let me overlay a quick global industry perspective, just echoing the point Nandini made on the earlier panel about the status US markets have in the world as the deepest, most liquid, broadest markets. A lot of that is because historically, in my opinion, the US regulatory regimes have generally supported and scaffolded innovation when they're at their best. And I say that, you know, looking at markets around the world, interestingly this year, in many of the conversations I was in Europe in particular, I got asked about crypto ETFs, and there was a strong sense that when the regulators got involved, that would mean the answer was no, and there would be no crypto ETFs. And that was just a good eye-opener to me, because I think right now the topic in the industry is the importance of clear, consistent regulation to allow more progress made and more investor participation in crypto markets, but that does prioritize appropriate guardrails and roles of existing intermediaries. So I think, like, yes, as an industry practitioner, like, it can always be difficult to understand and progress, but what we are able to do in the US has generally allowed us to innovate better than anywhere else with the help of our regulators and roles like 6C11.
One additional comment, and I'll keep it brief because I know that we're close on time, is that I think competition is a great thing. And so as regulation rolls out, I think an important thing to keep in mind is, does it introduce additional costs? Because costs are barriers to entry. And the financial industry typically has had low barriers to entry historically. And I think that has encouraged great competition within the US market that has driven down prices for the end investor. So I think from my perspective, competition is great. And so as long as regulation gets a fair playing field, low barriers to entry, then I think that's one ingredient that's required for good outcomes for end investors.
All right, I think we have time for one more quick question.
Thank you all for speaking to us this morning. My name is Nana. I'm a Master's in Sustainability student at AU. I just wanted to quickly find out, considering the substantial growth in ETF assets now and the potential cost savings that it offers to investors because of the low expense ratio, I want to believe, what is the future looking like for traditional asset managers with regards to their business models and profitability?
I'll maybe take a start and then you want to hop in. I think that, when it comes to fees, everybody is generally accepting market prices. And so there's competition that have driven down fees significantly across both index and non-index based implementations over the past decade. And I think that's good for the end investor. And what it's meant for asset managers is a couple of things. One, you need to make yourself more efficient. So there was comments on technology in the prior session. And asset managers have embraced different types of technology so that they can deliver the same or better services with fewer costs. And those costs generally have been passed on to the end investor through the kind of power of competition. And then there's been a lot of aggregation. And so you've seen asset managers being sold to other asset managers. Markets typically go through those types of cycles where there's aggregation and then fragmentation, and we seem to be in an aggregation cycle right now. And technologies help on both sides. And so I think that the whole emphasis on fees is important. The last thing I would say, though, on that is lowest fee is not the best. You have to understand the value for the fees that you're paying. And I think that's where financial professionals and so on can really help end investors, because who here goes out and tries to find the least expensive sushi when they want to have a meal? Nobody. Lowest fee is not always the best. And so I think that's a note of caution.
I agree with Gerard, and I will just add one other point, which is that it might surprise you to know that in the last 3 or 4 years, one of the largest sources of institutional adoption and demand for ETFs is actually asset managers who look to ETFs as their beta as a way to achieve market beta across different sorts of dynamic and changing betas in the marketplace, and part of their investment strategy, which allows them to then kind of take their time, focus, and research on their high conviction, more idiosyncratic positions. So actually ETFs have been a really important tool in delivering alpha, which gives me the opportunity to end where I started, which is that there is nothing passive about ETF and index investing.
Thank you. That will do it for this panel.